If we want to understand today's modern economy, we first need to ask a very basic question. What is money really? Today, the currency we use, paper notes, bank balances, and digital transactions, all feel completely normal to us. But throughout history, money was not always like this. Thousands of years ago, people used the barter system. One good was exchanged for another. But as civilizations developed, the need for a common medium of exchange became clear. And that need led two metals to become the most important monetary assets in the world: gold and silver. Gold and silver had qualities that no other commodity possessed. They were rare, they were durable, and they could easily be divided into smaller units. Because of these properties, many ancient civilizations, including the Roman Empire, Chinese dynasties, and Middle Eastern trading systems, used gold and silver as money. Coins were minted that contained real metal. People knew that if they owned a gold coin, its value was real. It was not just a promise, it was a physical asset. For this reason, for centuries, gold and silver formed the foundation of the world's financial system. As the modern banking system developed, governments began introducing paper currency. However, there was one important rule. Paper currency was only trustworthy if real assets existed behind it, and those assets were usually gold. This concept became known as the gold standard. The basic idea of the gold standard was simple. Every currency was linked to a specific quantity of gold. In other words, if someone held paper money, they could theoretically exchange it for gold. This system created stability in global trade. Countries could trade with one another because their currencies were tied to gold. By the middle of the 20th century, the global financial system was operating largely on this principle. After World War II, when the global economy needed rebuilding, a new monetary framework was created. This system became known as the Bretton Woods Agreement. Under this agreement, the US dollar was fixed to gold. The official price of gold was set at $35 per ounce. Other countries then linked their currencies to the US dollar. This effectively made the US dollar an indirectly gold-backed currency. And because the United States was the most powerful economy at the time, the dollar became the world's reserve currency. For several decades, this system maintained financial stability around the world. Central banks held gold in their reserves. Governments tried to maintain stable currencies. But over time, new economic challenges began to appear. During the 1960s, the United States dramatically increased government spending. The Vietnam War and large social programs significantly raised government expenditures. To finance this spending, the money supply also began to increase. And whenever the money supply increases rapidly, a risk appears: inflation. Foreign governments and central banks began noticing that the supply of US dollars was growing rapidly. Many countries started converting their dollar reserves into gold. This situation became dangerous for the US financial system. Because if every country demanded gold at the same time, the United States would not have enough gold reserves. By 1971, the pressure had become so intense that a historic decision had to be made. U.S. President Richard Nixon made an announcement. He temporarily suspended the system that allowed dollars to be converted into gold. This event became known in history as the Nixon shock. The decision meant that the U.S. dollar was no longer backed by gold, and that moment marked the beginning of the modern financial system. From that point forward, currencies were no longer valued based on gold, but on the policies of governments and central banks. Paper money officially became fiat currency. A fiat currency is money that is not backed by a physical commodity. This system had some advantages. Governments could increase the money supply during economic crises. Central banks could control interest rates. Financial markets became more flexible. However, the system also had a downside. If governments printed too much money, the value of a currency could gradually decline. And this is where the importance of gold and silver becomes clear once again. Gold and silver have naturally limited supply. They cannot be printed. They can only be mined. Because of this, whenever currencies weaken, investors historically move toward precious metals. Gold and silver are often seen as stores of value, assets that can preserve purchasing power over long periods of time. Now, if we look at the world in 1947, precious metals were still a central part of the global economy. Gold was the primary reserve asset of central banks. Silver also played a role in many countries' monetary systems, But over the next few decades, the global financial system was about to change dramatically. And that change would directly impact the prices of gold and silver. A metal, once fixed at $35 per ounce, would eventually reach thousands of dollars. And that story was only just beginning. The next chapter begins with the moment that started the modern price journey of gold and silver, the year 1971. The moment when the world's monetary system changed forever. The year 1947 was a turning point in world history. After World War II, the global economy was slowly rebuilding. Industries were rising again. International trade was restarting. New nations were shaping their economic identities. During this period, precious metals, gold and silver, were not just investments, they were the backbone of the global economy. The world's monetary system operated under a structured framework known as the Bretton Woods Agreement. Under this system, the official price of gold was fixed at $35 per ounce. That meant if a government or central bank held $35, it could theoretically exchange them for 1 ounce of gold. This system created currency stability. Countries pegged their currencies to the US dollar, and the US dollar itself was linked to gold. That is why gold was considered the most reliable financial asset in the world. If we look at local markets in South Asia in 1947, gold prices were astonishingly low compared to today. At that time, 1 tola of gold cost roughly 80 to 90 rupees. If someone owned 10 tolas of gold, its value would only be a few hundred rupees. Today, that same 10 tolas of gold is worth hundreds of thousands of rupees. This difference is not just about the price of gold. It reflects the loss of purchasing power of currencies. In 1947, a monthly income of 100 to 150 rupees was considered respectable. A government employee or school teacher often earned around that amount, and with that income, people could comfortably support their families. Silver also played an important role in the economy. In international markets, silver traded at around $1 to $2 per ounce. In many countries, silver coins were used in daily transactions. People did not only wear silver as jewelry, they also used it as a form of savings. In rural areas, many families stored their wealth in silver, because silver was affordable and widely available. If someone purchased 100 ounces of silver in 1947, the cost would only have been a few $100s. Today, that same amount of silver is worth thousands of dollars. At that time, gold and silver represented one powerful idea: stability. People knew that if they owned precious metals, their wealth was secure. Currencies were also trusted because they were backed by real assets. But the global economy was about to change rapidly. By the 1960s, the United States had become the most powerful economy in the world. The US dollar became the main medium for international trade. Central banks began holding large amounts of dollars as reserves. But during this period, a problem began to develop. US government spending was increasing rapidly. The Vietnam War and domestic programs required large amounts of money. To meet this demand, the money supply also increased. And when the money supply increases, currencies come under pressure. Foreign governments began questioning whether the US had enough gold reserves to cover all the dollars in circulation. Because of these concerns, many countries began converting their dollars into gold. France was one of the countries that openly demanded gold from the United States. This situation became increasingly dangerous. Because if many countries demanded gold at once, US reserves could quickly decline. By 1970, the pressure on the system was immense. And then came the moment that changed monetary history forever. President Richard Nixon announced an emergency economic decision. The United States would suspend the convertibility of dollars into gold. This historic moment became known as the Nixon shock. From that point forward, no country could exchange dollars for gold. It was described as a temporary decision, but in reality, it became permanent. And that moment created the foundation of the modern fiat currency system. From then on, currencies were valued not by gold, but by government and central bank policies. This change would have a massive impact on precious metals, because once gold was no longer fixed to the dollar, its price began moving freely in the open market. And when gold started trading freely, a new chapter in financial history began, the inflation crisis of the 1970s. And that is where the modern price explosion of gold and silver truly begins.